There we go, 2 p.m.
Brilliant, look at that. And we're live. So I was instructed by Masha to just wait a minute or two to let people join the chat. Well, I guess as we're doing that, we might as well kick off and slowly start introducing the panel today. So welcome everyone who is tuning in to watch this panel live across whatever platform you're tuning in on, LinkedIn, X, or just StreamYard itself. I know we've got a fantastic conversation lined up for you today with some experts in digital assets risks and insurance. My name's Alex Saleh. I will be your host. I'm the head of partnerships at Native, and it is an absolute pleasure to kick off the first Risk Collective live panel of our series today. The Native Risk Collective is a risk management ecosystem that Native has pioneered with leading Lloyd's underwriters, including Mosaic Insurance. We have the brilliant Kieran from today, and Chaucer, alongside our risk management partners, Hypernative, Circuit, Hacken, Station 70, and BreachBits. The idea behind the Risk Collective is very simple. We've collected some of the very best risk mitigation tools for blockchain and digital assets companies and paired them with cyber, crime, and tech insurance that has been designed specifically for digital assets businesses. By using these brilliant technology vendors, our clients not only get access to this tailored insurance, but can also unlock discounts for those insurance premiums too. That's enough of a sales pitch. It's very exciting, but if you do want to learn more about that today, you can talk to us directly at Native or absolutely anyone on this panel, or if you use any of the vendors, get in touch to learn a little bit more. So on to today's panel, we'll be exploring the evolving risk landscape in digital assets from tech vulnerabilities all the way through to human factors that lead to exploits and on-chain risks playing out. And ultimately, how this industry is adapting to emerging risks, including things like agentic AI agents behaving on chain, and perhaps we'll even get onto things like systemic risks, quantum, things like that as well. But before we dive into those brilliant topics, I'd like to introduce our panelists. So, Kieran, I think I'm going to pick you to be up first. Please introduce yourself, tell us a little bit about yourself, your role at Mosaic Insurance, and also, if you could, share a little bit about what you're currently focusing on as well.
Perfect. Thank you, Alex, and thank you for having me. I'm excited to be here. So, as Alex says, my name is Kieran Quigley, so I'm from Mosaic Insurance. We are a global specialty Lloyd's syndicate. I'm based in London, but we have hubs all across the globe. So US, Canada, Bermuda, Europe, Dubai, Singapore. The list is kind of endless at this point. Cyber and tech is our biggest line at Mosaic. So it's a lion's share of the business we operate in, and it's our major growth area for us. So we're super excited about growing that line and also exploring new emerging risks like digital assets. So I've been in the insurance market for around 7 or 8 years now, always focused on cyber, always focused on emerging risks. And a lot of that time has been spent underwriting large, complex risks that you might see blue chip type companies that are part of everyone's conversation or part of the society. But like I say, that focus has always been on emerging risks, particularly on things like digital assets, on AI as well. So from Mosaic's perspective, we've just entered digital assets from an insurability perspective. So we're super excited about the opportunities that it presents for us. And I think we've really seen that market grow massively over the past couple of years. It's quite insane how quick it's grown. So we see it's a real growth area for us. So we're very excited to bring insurance to this underserved industry vertical, essentially.
Yeah, brilliant. And I mean, it's fantastic to have you today here, Kieran, but also just from Native's perspective, to have you in the middle of the Risk Collective, bringing your expertise from, the traditional cyber perspective, and bringing all of that expertise into underwriting digital assets risks. Very lucky to have you. Thank you for being here, not just on this panel, but obviously contributing to the Risk Collective as well. Dan, I'm going to pick on you next. Great to have you here. Could you introduce yourself? Tell us a little bit about Hypernative, your role there in founding Hypernative and kind of pushing it, driving it forwards. And then also, love to hear what you're currently building and what you're currently focused on too.
Sure. So nice to meet everyone who is listening. My name is Dan. I'm the CTO and co-founder at Hypernative. We basically we started a few years ago and built our prime mission when we started was to prevent smart contract hacks and exploits. They were very, at least when we started and still today, unfortunately, attacking smart contract remains something which is very lucrative. So when we started, there was no real-time prevention for this for smart contracts. It was only audits, which maybe we'll talk about later. And we introduced the first real-time prevention platform. From there, we established ourselves as a leading player in that and expanded to other forms of risk, real-time risk mostly, financial risk and transaction risk and other things that I'll be happy to expand on. We had a few notable cases where we saved funds in real time. So that was kind of like a real-time action. Attacker is preparing, we identify, we fire a pause. Attacker, we even trapped an attacker inside the protocol once and they lost the funds. So we have a lot of cool stories from the front lines.
Yeah, brilliant. And, really excited to kind of dive into those, hear the blow-by-blow action stories as to, how we can fight back against these things. I think personally, I've been working in the space kind of 5 to 6 years now, so not forever, but it's amazing how much the technology has changed in that time, right? I remember when I joined, it was every week, there was a smart contract hack, exploit of some kind, a bridge attack. And it does now seem to be that the tools and technology to fight back against these kinds of behaviors is now there. So yeah, in such a short space of time, we've developed some really brilliant tools, no doubt to a lot of work put in on your part. So yes, looking forward to diving into that today. And then Harry, last but absolutely not least, please introduce yourself. Tell us a little bit about your work at Circuit, what you're focusing on at the moment as well.
Cool. Thank you, Alex. And thank you everyone who tuned in. My name is Harry. I am the CEO and founder of Circuit. Circuit recently publicly launched. What we do is we focus on real-time response and preventing catastrophic operational losses. So falling under kind of 2 big buckets. One, disaster recovery or asset recovery. But if wallets fail or bankruptcy occurs or for any reason you lose access to private keys or credentials, we allow you to retrieve your funds automatically without giving private keys to a third party. So you don't have to trust us, but we can still get the funds out. And the second being able to automatically provide effectively instant response. If you're able to detect an attack or able to detect some form of alert, we can take an action on the back of it for you to flip your funds to safety. And yeah, we work with wallet providers. We're starting to work with more funds, exchanges, and basically lots of players in the ecosystem who want to prevent these losses from happening and not having to trust any third parties as well. So super excited to be here and to chat more.
Yeah, brilliant. Great to have you here, Harry. Great to have your expertise. And look, I think what we'll do is we'll jump straight into the discussion. There was one thing you said there, Harry, that really kind of made me perk up a little bit. And it's the way you describe the risks that Circuit meets and prevents, right? One thing that we do in this industry all the time is we bucket things into categories: disaster recovery, real-time threat monitoring, and we jump on these terms and we jump on these kind of waves, but we very rarely then tie that back to the way risks play out, and then especially in insurance too, tying them back to different kinds of insurance and how they respond to real risks and scenarios that play out in real time. So I think as we go through our discussion today, we'll definitely think about, is the right way to go about this thinking about it as a holistic approach, or is it bucketing up these risks into categories and finding solutions to meet those specific risks and insurances to meet those specific risks, or was taking a broad holistic approach more effective? We will discuss. Anyway, so jumping straight into it, kind of laying out the lay of the land, right? The past 24 months, I would say we've seen some really high profile attacks. I mean, staggering numbers entirely, right? Names that come to mind are WazirX, the Bitcoin exchange out in APAC, DMM, lost 305 million, WazirX lost 235 million. And of course, the hack that everyone keeps talking about, because it really just blew everyone away, the Bybit attack, staggering $1.5 billion worth of losses, right? Which I think in any industry, not just inside digital assets, but Kieran, in any industry, is a staggering amount of financial loss, right? So from an insurance perspective, yeah, very deeply interesting. Where I want to start is, given this diversity of the way these attacks played out. They all played out slightly differently. They all had different kind of methodologies and different attack vectors that were used. Looking maybe at Harry and Dan first to take this question, what do you think are the risks, those bucketed risks that are top of mind for crypto companies as they engage with the wider crypto ecosystem, right? What's keeping them up at night? What are the things that they need to be thinking about in order to defend against these kinds of risks and becoming one of these stories? Dan, I'm going to pick you first.
Sure. So I think in terms of Bybit and Wazir and all those, so this is like what when I described earlier, transaction security. So at the end of the day, it doesn't matter like how much security you do. Someone eventually is signing something, and I think everyone's finger is shaking a little bit when they sign something that they know should pass, I don't know, $100 million or whatever, or they sign something from a wallet that actually owns $100 million. And I think there they have basically a lot of risks that they are like considering. So and by the way, this is a very timely discussion because just yesterday there was a huge supply chain attack with the NPM packages, whoever heard, which, by the way, is a very similar, I would say, attack vector to how a Wazir or a Bybit would happen. And then so you're afraid first that whoever you're interacting with is breached, and then you're signing something, you're seeing a list of bytes, and you don't even know what that is. So now you need an expert that will interpret that. So I think all this, like, are they impacted? Now, was I served something which I meant? Is what I'm signing even a mistake, just an honest mistake? Like I think Harry mentioned, there is like catastrophical risk that can, like, you'll send your USDC to the USDC contract, so you're pretty much gone. So there's operational risk, which Harry mentioned, and then there is maybe inside threat, right? So there are people inside the organization that can make something that would appear external, but it's actually an insider threat. So you can go from your counterparty, so it's a counterparty risk, but from a security perspective. And then there is basically like, okay, so the counterparty is okay, but I'm making a mistake, which is catastrophic. And then there's also the internal risk. So this is just for, like, I would say, transaction security buckets, Alex, because you mentioned buckets. So I think those are three.
Yeah. I mean, Harry, would you say that your perspective is broadly the same? Obviously, a lot of what Circuit does and a lot of your expertise as well as threat prevention is on thinking about things like business continuity and disaster recovery. Do you think, so much of the crypto news cycle is based on exploits and the theft of assets and not so much on outages and failures? Would you say that those buckets of risk are as top of mind for CISOs and CEOs as well? Or are they kind of not really focusing on that as much as they should be?
I think, first of all, I agree with what Dan said. There's a lot of transaction-based security that you need to add on top. Ultimately, what you're trying to solve for is any event which will cause you to lose access to your assets or lose the assets themselves. And loss of assets would fall broadly under what Dan mentioned. The ability to someone to fat finger, for someone to get through transaction policies, for someone to take access of credentials and send funds to somewhere they're not supposed to go. All of those will cause you to lose all of your funds. Then the second bucket would be loss of access to the assets themselves. So if you lose the private keys, if you lose the credentials, if someone internally dies or a quorum and no longer has majority, the wallet provider you're using or the signing service you're using disappears or goes down and has downtime, that'll also cause you to lose access to those funds. So that's an additional bucket which people aren't quite concerned about. Ultimately, it's part of their business continuity planning, it's part of their disaster recovery. And that's an area which, if you are risk conscious and security conscious, you have to have covered. In certain cases, it's required by regulation. If in the EU, you need to show your redundancy. You need to show that you have this in place. And going over to Kieran, the next part of that would be having insurance in place as well after you have that redundancy and business continuity. So if we're going to take all those buckets and then combine them together into that holistic sense, preventing loss of funds at the transaction level, you're not signing the wrong thing, or you're not sending funds to the wrong place. Ultimately, any loss of funds will be sending funds to the place they're not supposed to go, and then being actually able to sign in the first place. Can you sign a transaction? Do you still have the credentials? Do you still have the keys? Or is the person who's providing you with that service still online, available, able to sign that transaction that enables you to do it? And then if there's any edge cases or any aspects that fall out of that, having the insurance backing to be able to fall back upon in the event that you've gotten through all the layers of security in place. So that was basically what I'd add to it. The best, most security conscious people in the space have all of those brackets covered.
Yeah, absolutely. I mean, personally, I find it terrifying. It's incredibly exciting, right? This world in which we exist in. But what I'm hearing from both of you guys, there are so many ways for an attack to originate. From inside your company, from outside your company, the sources are endless. I mean, Kieran, sometimes I hear insurers kind of have a little chuckle because this is nothing new, right? This has existed in financial services for as long as financial services have been a thing, at least digitally, right? So what do you think when you hear about this? I mean, is it new news? Is it everything that you've kind of dealt with before? The technology is different, but the concepts.
Exactly that. I think it's not new. I think you can get carried away, at least from an insurance angle or financial angle, with the buzzwords and the excitement around all this. But if you strip off that digital asset label and really break it down into what are those risks, we've pretty much covered them now. So it's custody breach. So essentially breaching your systems, whether you are trading crypto or trading stocks and shares, or you have a platform that goes through payment processing. The risk there is very, very similar. We're aware of that risk. Everyone's aware of custody type risk. That's what you think of. Often when you think of digital assets, your mind goes to that cryptocurrency Bybit style loss. I think the insider threat one's interesting because you can have all this great tech externally that protects that unknown actor, but often it's the person in your own house that can cause the biggest problems. So we're seeing that really bubble away. But I think as the market generally has matured, what we're seeing a lot more is that regulation focus. So you think of 12 months ago, I would say that most companies weren't really thinking about regulation because there wasn't a framework there. They were asking for regulation, so they knew that they were operating out with the grey and the black and white. So you've got the global patchwork regulation that we see now. You've got MiCA in Europe. You've got the Genius Act in the US. And while these are all grey, it does provide a different layer of risk that companies need to consider about. So if you think of the Juarez X incident, that wasn't a hack, it wasn't a breach, that was just a regulatory oversight and then basically freezing assets. So it's quite an interesting angle where it's not that malicious angle or that threat actor that we often think about. It's a regulation enforcement. So I think as the market matures and we see regulation come up throughout the world, that's a different focus that especially companies that are in that scale mode will have to consider. So I think if 2023 and 2024 really was that focus on theft and technical exploits, I think 2025 going forward should be on operational resilience and compliance, because it's not really if a system goes down or if you are hacked, it's can you survive a hack, can you survive a rogue insider, can you survive questioning by a regulator. We're kind of at that point of the maturity journey now, which I think is quite interesting, because previously I don't think it was all about the technical aspect and not about the commerciality perspective, at least from an insurance angle. That's what I'd say.
Yeah, absolutely. And I think, it's amazing we've got this far and to these volumes of assets without, regulations mandating tools like Circuit and Hypernative are in place, right? And I think that is starting to happen now. Insurance is definitely mandating, to access better insurance and better coverage. It's definitely mandating that these kinds of safeguards are in place. So we are absolutely moving forwards. I want to jump forward a little bit. I mean, we could talk about these things all day. It's amazing how quickly time is flying as we get into these details. So I'm going to keep pushing forwards here. The hacks that we've mentioned so far, right? Wazirx, Bybit, and you guys have touched on this as well, right? Some of the biggest threats are all around human compromise. So it's not always about bugs or exploits inside the code of the apps we're using or inside the blockchains themselves, but it's the insider threats, the social engineering, the people making mistakes, where they give bad actors a little bit of an advantage to then go and wreak havoc. I got one notes written down here. I don't know if anyone remembers the Ronin bridge attack. Allegedly, as I was doing research last night, started with faked LinkedIn job offers. And we hear these stories all the time, right? Lazarus groups have 2, 3, 5 year campaigns to get employees inside companies to wreak havoc. So the question I want to ask here is, really, should we be focusing on the human elements that leads to the origination of attacks, or should we be focusing right near the end of how an attack is finalized, which is always a transaction, right? No matter how these things start, you need to sign a transaction to then go and steal the assets and move it to another wallet. What is your perspective on where we should be focusing? Harry, perhaps we'll start with you, right? Because you have a really good expert knowledge on, everything that Circuit does. There is the recovery angle, but there's also in the kind of making sure that you can respond to these threats in time. Do you think companies should be focusing on protecting their humans, protecting their humans from making mistakes, the devices, preventing phishing, or is it really better to focus on the end, right as they sign that transaction, to make sure that it's intercepted, prevented, and the assets are kept safe?
Ultimately, both. I have to say is that the more safeguards and defense in depth you have, the safer you'll ultimately be. If you're just relying on one thing, then that's the one point of failure that will be targeted. And so if you're able to say, great, we have this check and this check and this check and this final check, that's a much, much better solution than we're relying on this one single point. And you see that with many different kind of exchanges which have been hacked, have relied on a single wallet provider, and that's their security. And what ends up happening is they find the weakest link within that wallet, and then the funds are moved. Maybe they bypass the tap policy, or they get an API key, or they find someone to get internally collude. In the Ronin case, they find that they can get a multi-sig quorum. There's no other check, and then the funds are disappear. And the issue, unfortunately, with crypto is that because they're bearer assets, when the funds are gone, they're gone. So you should have multiple layers. You should have as many as possible, ultimately. And I think, to Dan's point, ultimately, everything does have to happen as a transaction. The only way funds move on a blockchain is if you take a transaction, you sign it, and you execute it, and it gets settled. So putting a lot of emphasis and effort on double checking and ensuring there's the ability not only to not sign a transaction, but also to get ahead of malicious transactions, that will help against a lot of input vectors. But you should also try and nail down all the different inputs that could occur and the reasons why people would sign these malicious activities, make sure there's double checks, make sure there's verifications, as well as having that last line of defense. So that would be my take on it, is that because it's the last final piece, it is this kind of choke point. And if you're able to provide good security at that choke point, it will mitigate a lot of the attacks, but you shouldn't disregard everything else just because you have that in place.
Yeah, makes sense. I mean, Dan, do you agree? I think, knowing what I know, and I'd love to learn more, and feel free to, share details, but knowing what I know about Hypernative Guardian and Hypernative Platform, yes, there's absolutely that, final transaction simulation elements where you are preventing the very worst from happening at the last possible moment. But there is also a lot of monitoring that happens beforehand, right? So trying to recognize signals that control has been lost, or perhaps there are people engaging with these assets and controls that shouldn't be. Can you talk to us a little bit around how that all kind of builds up to be a bit more of a stronger cybersecurity posture than just focusing right there at the end?
Sure. So thanks, Alex. So I think anyone who's so my in terms of background, like it's I haven't started cybersecurity just in crypto. So we are coming from the company from like a background of cybersecurity, and I think anyone who is coming from cybersecurity has to admit or testify that cybersecurity is a layered approach. Right? It doesn't matter what layer you're building, but there is other layers are important. So just like the NPC layer of the most institutional wallets is critical. So I think all the layers, as Harry mentioned, are important. And I think an example, not speaking just headlines, if you look at, I would say, even the alerts that would come on the transaction security. So there needs to be someone that would adhere to these alerts, because as Harry said, eventually if they decide to sign, they will sign. Now, we need them to not ignore the alert. So now they need to get accustomed to, okay, I know the alerts are like, if I see a red, it's critical. I'm not moving. I'm like, I'm afraid of this. So that means you need training, and people need to work with those tools to understand, okay, usually I see this type of alert, which is say green. It gives me the interpretation that I'm used to. Now I'm seeing something else. Maybe it's red. Maybe it's just different, right? So that's a human factor. And in order for that human factor to be trained, they need the tools, right, to do that. So just taking it to the areas that I'm a bit more familiar with, for example, Guardian and the monitoring. So two examples that can be interesting is that for example, in the way our customers are using that, or how we try to push them and use it is, so we have, like, we can tell you this is scam, this is fraud, like just don't touch that. That's 100%. But maybe to go towards the areas where Harry is also discussing, a lot of our customers are building custom flows on Guardian. It's a programmable product where you can say, all right, I'm trying to swap, right? And I'm swapping into the wrong address. There's a lot of like swapping that can be done that you will say to which address you want to swap. So it can be operational, it can be malicious, but you're doing a mistake that will be fatal in that regard. So you can actually build a lot of those things. It is a transaction level, but it's like you need to train the people to think, okay, everything that I'm doing, I need to think, okay, how can I validate that I'm actually doing what I'm doing? And this is a step before, yes, it culminates in the transaction, but it's a step before in terms of the education, in terms of the perception of the organization of how they're actually working. And in terms of monitoring, if you have critical wallets, right? Like let's say multi-sig signers, for example. So the multi-sig signers should never do anything but signing the multi-sig. It's just not, it's not sanitary, quote unquote, for a multi-sig signer to do a lot of different things. So how would you validate that, right? So you need to monitor the multi-sig signer. And then if you see the multi-sig signer buying an ape, so we're not in a good position from security perspective. So those are just like two examples of how you would treat those things a bit earlier, right? Yes, it culminates at transaction level, but the organizational process starts, I think, earlier.
Yeah. Kieran, you know, how granular when it comes to underwriting these risks and understanding these companies, effectively, you know, correct me if I'm wrong, but as an underwriter, you're taking the decision, you know, once you've received all the information to back that company. You believe it's a good risk, and if the very worst happens, you're there for them. But you also need a bit of confidence that they're doing things correctly, right? So how granular do you get in understanding maybe those more human and organizational elements versus this is our tech stack, this is our business model, this is how we operate? Is that human, dare I say, cultural element around cybersecurity also accounted for when you're thinking about what makes a good risk?
Yeah, I mean, Harry and Dan are doing a perfect job of summarising it all perfectly for me, so I don't have too much to add, but it definitely is that layered approach. There isn't one silver golden bullet to all this, and one thing doesn't fit everything and solve everything. If it was, none of us would be in a job, let's be honest. So it's that constantly moving threat. I think in the front end, you really have that human aspect, so you want to talk about, that's that early prevention, so the first line of defence. So to Dan's point about training the staff, what to do, what not to do, you've got simple things from a cyber perspective like MFA, phishing simulations. That should really reduce the frequency of those successful attacks. And most of the scams that we see can be stopped at that initial stage. But then they won't stop everything, and that's something that we just need to accept. You can never stop everything, and it's ones that what happens when it gets through that first layer. So it's really at that back end transaction stage. So what have you got for fraud detection? What have you got for approval thresholds, kill switches, automatic sweeping? So should an attacker make its way to that point in time, how are you preventing the severity of losses? So from an insurance perspective, we really think that early interception should prevent a lot of smaller claims. And then that late interception should prevent a lot of that one large cat balance destroying loss. So the firms that we see that we think are the most resilient and the most insurable are those ones that really invest in that layered approach across the full chain. So not just one point, because if you get to point 1 and it kicks it out, okay, there'll be a threat actually that can get to point 2, point 3, and it's all about just putting those hurdles in place and how far they can get through your organization before a hurdle eventually trips them up. So the more hurdles you have, essentially, the harder it is for them to get to the finish line. So that really layered approach should try and minimize the loss. There will always be a point where you can never be billions of hurdles. There'll always be one point where someone can get to the finish line, but you want to make that finish line as far off in the distance as possible, and putting those hurdles or those layered defenses in place is what we like to see. You've got that technical aspect, but you've got that human aspect from both different perspectives that should try and minimize the exposure there.
Yeah, brilliant. That makes sense. I'm going to take a quick pause here. I've been given a reminder to remind our audience that you can ask us any questions in the comments. I think whether it's on YouTube, X, LinkedIn, you can actually comment and we will do our best to answer any questions you have. You have some of the very best risk experts in this space on this panel, so feel free to fire your questions at them and we will field them. It's funny, Kieran, you made that quip about this is what keeps everyone on this panel in a job. I think this is one of the things we were discussing very briefly before. I think cryptocurrencies as a concept have been around for 15, 16 years now. That's not the longest of times, but it's over a decade now. And that whole time we have gone through this process of developing tools to keep assets safe. I mean, smart contract auditing has been around for as long as smart contracts have. And yet every year we're still seeing major exploits. We're not really trending down and to the right when it comes to the theft of assets. If anything, every year it's increasing. And I guess the question to all of you guys, and feel free whoever wants to take this one first, is this because the technology is nascent and the actual value of that capital is still growing? Or are we kind of missing a trick, right? What's the missing piece here? Are hackers getting better? Do we need to develop better tools? Or is it just really a product of this is all still very new and we're going to keep seeing large-scale exploits until we get to almost a standardized operational model of how we deal with digital assets? And then the final thing I want to throw into the mix, because I actually don't know, and I would love to, maybe Kieran, you have the answer to this, is does this happen all the time in the TradFi world and we just don't hear about it because it doesn't make for a sexy news headline? Is there anything we can learn from those guys in the TradFi world, or have they now got a handle on it and it's up to the digital assets world in the same way to go through that journey? A lot of questions there. Who wants to? Is anyone going to raise their hand?
I'd love to hear Kieran actually give us the Web 2 perspective, the financial perspective, and we can come in.
Yeah, I mean, the TradFi world definitely has, you could argue, a stronger grip on this, but so they should. They've been around for far longer, and they're, for all intents and purposes, got their hands on a pretty static risk or a slow-moving risk, whereas crypto digital assets doesn't have that privilege or that head start. So it's very, very similar to the cyber market generally, and digital risk generally, where the market and the frameworks and the risk environment is growing in real time with the business. So it's not like we're in the sandbox, we're creating the rules of play, and then you launch the business. The business has been launched, and the rules are being wrote maybe 5 years after the business launch, or at least in tandem. So you have that complexity, whereas on the TradFi world, you very much know, okay, this is the rules of play. You play in the sandpit, you do this, or you don't play in the sandpit, you do this. It's very, very simple to follow a framework. So I think from our perspective, it is just about, I think digital assets are really good at the technical aspect of their business. So they really understand the technology, and they're obviously very passionate about it. And they, for all invested purposes, the technology stack is best in class. But often it's to your point where we're still seeing these attacks happen with things like smart contracts, where obviously audits and bug bounties and other things aren't enough. So what is the missing piece? Well, I think a lot of that catches known issues, but they don't prevent new ones taking place. So I really think that missing piece is that post-launch type governance or awareness. And that constant moving beast, similar to cyber, it's a very dynamic risk. What's great today is bad tomorrow, and vice versa. So you can't write it and you'd be done. It's a constantly rewriting of it all. I think a lot of the things that we see is that the governance after launch can be quite weak. So once it's deployed, the contracts run automatically, and they obviously can't be patched quickly then. So what happens, how are you controlling that risk? Well, some projects we've seen have kill switches or emergency protocols, but many don't. So from an insurance perspective, without those governance levers, for lack of a better word, even really small issues can spiral suddenly into full limit loss from an insurance perspective. So we want to look at protocols that have a grip around that to try and contain the damage. I think as well, a lot of the technology stack that we see in digital assets, and this also transverse to the TradFi world as well, perhaps not to the same extent, but it's definitely the same exposure, that there's a lot of hidden dependency risk. So many of those contracts reuse open source code. So if that library has a flaw, every project built upon that is potentially exposed. So from an insurance perspective, that creates something we call aggregation risk, where essentially if all of our insureds are using the same technology, that suddenly an event could trigger that for a portfolio-wide perspective, leading to billions, if not trillions, of potential insured losses. So for us, obviously, that keeps us up at night, where one event can trigger all of our policy holders simultaneously, whereas you compare that to a physical peril like property, the likelihood of all your property portfolio globally going down a hurricane is very limited, whereas digital risk and protecting digital assets, there's no geographical boundaries. The risk can spread instantly worldwide. So for us, it's harder to really get to grips with that risk. And I think the last thing I'd probably say before Harry can jump in is that the unintended protocol interaction. So I think a lot of contractors really operate in isolation, essentially. So one exploit and a DeFi protocol can cascade into exchanges, lenders, custodians, and you have that systemic hidden element again that as insurers, it's a never-ending concern for us about aggregation and systemic loss. So a smart contract could potentially be a systemic risk for us. That would almost be like the subprime mortgage of 2008, but a digital asset perspective. So for us, I think those sort of main themes is what keeps us up at night. Like I say, the technology is great, and often there's a really firm grip and understanding of that, but it's that wider impact and mostly that dependence. So I think audits aren't enough for us. It's that governance, accountability, and resilience planning after deployment to see what happens. And I think that really determines for us what's insurable and what's uninsurable. We're always thinking about what happens if it goes wrong, because everything's great until it doesn't work. So for insurance, we're always thinking, well, if it does go wrong, what happens? And that's kind of the viewpoint that we're sort of coming from.
Yeah. Yes. I think exactly to Kieran's point, we're not going to see a world with zero crypto losses in anytime soon. And I think part of that is we're using an open decentralized ledger, which is public and to an extent permissionless. And so because anyone can build on top of it, we've created this beautiful Lego block future of finance where you can take from this and take from this and take from this, and then it goes through here, which is fantastic until one part of it goes wrong and then all of it falls apart. It's like have you seen the XKCD comic where there's this beautiful big tower and there's this one tiny little block at the bottom? It's like there's one developer in Winnipeg, his computer gets hacked and then everything falls apart. And it's wonderful in the sense that things can move very quickly, but it's also has these issues such as the NPM issue that was discussed today, where if a single open source package or a single open source developer in this case is compromised and is able to push some code, it can affect literally millions and millions of people, which is, to Kieran's point, crazy aggregation risk. And if you have to look at every single point of the supply chain and say, okay, at every single point in time, this is a platform, this is a platform, this is used by lots of people, then it becomes, there's lots of catastrophes waiting to happen at any point, and you need to lock all of them down. To the kind of subprime mortgage crisis, the reason one of the subprime mortgage crises was such a big issue is because it caused systemic failure of like the Lehmans of the world, where all of these people were relying on a counterparty to maintain and manage their assets. And once they went down and disappeared, you couldn't get their assets out. And so for Kieran, that's a really bad event because it means, okay, well, everyone's going to call me at once and ask for my money back. And that's a total disaster. And
bad day in the office, yeah.
And that's Kieran's worst nightmare, exactly. And that's where one of the things we built at Circuit, or automatic asset extraction, means that even if your wallet provider, think of it like that, a platform which would have a lot of aggregation risk for Kieran, if everyone's using the same wallet and they go down, they're all going to claim. And so Circuit enables you to always retrieve your funds and sweep them to a backup wallet or sweep them to a backup custodian, reducing that aggregation risk and reducing the concentration risk. So if we get another Lehman type scenario where large major industry player that no one expects to go down actually does go down, you're still able to retrieve your funds. And it actually makes it a lot easier for the industry to continue forward because not a lot of those funds are trapped. So taking that broader step out, I think there is definitely much, much better ways as an ecosystem that each part of the supply chain can be locked down, because it's a pretty linear process from someone signs a transaction to it goes through these transaction policies, through it goes through a second layer, potentially of Hypernative Guardian, it goes through another layer of Circuit defense of response, then it gets broadcast and it gets confirmed, and you can then look at the blockchain to see who's going to be validating it, who's going to be relaying it. All of these are actors, all of these can be pointed towards. And if you're able to, at each point in time, add additional security and additional checks, it becomes a very, very small probability at the end of it that something gets through. But there's still that probability, and you need to be able to protect against that, which is ultimately where Kieran and insurance comes in. But those definitely can be mitigated, it definitely can be reduced. And that's ultimately why we're here, because we're saying the state of the affairs is still not good enough. $3 billion has been lost this year to date, and we need to be able to do something to stop it.
Yeah, absolutely. And Dan, I'd love to pull you into this discussion. I'm thinking, with your cybersecurity background, and as you think about all of the products Hypernative are yet to build, but you're thinking about how to build them, how do we move from this sort of reactive situation where large-scale exploits happen, and then we change the way we operate and we build tools to prevent those exploits from happening again, to get into a state, I think, Kieran, you use this a term, a static risk or a steady risk, right? Can we get to a point where we build the right tools that these risks are manageable so that they become a static risk and we're proactive in preventing against them, rather than, every year or two changing that risk paradigm changes so that we change the tools that we're using and upgrade the tools we're using?
So I think that it's a very tough question to say, how do we move the risk?
Yes.
I think that eventually, if I take the insurance part, because eventually I think insurance is our barometer for this, because if someone is willing to insure, it means that it's reasonable to an extent, and if they are lowering the price of insurance, it means we are making progress. That's eventually, because
Yes.
the insurance is the market value of the risk, in a way to look at it. So I think maybe I'll tilt your question just a little bit, like, how do we make proactive or tools that, how do we build tools that manage to lower the insurance risk? And I think in that regard, so if you're looking at DeFi, for example, so you have basically the person using the DeFi protocol. So that person would be, I don't know, whoever. It can be a hedge fund. It can be an asset manager. It can be even exchanges today are using DeFi for various earn products and whatnot. So now they have to protect themselves against activity with DeFi, and that again goes back to do you know what you're doing? Are all the transaction against you're doing now? I'll simple examples. A lot of those DeFi protocols. So technically, you're doing something which is legal, no problem. But if you're not doing the transaction, and all of them would be programmed. No one in those platforms like a Coinbase that would work with a Morpho or whatever, they have everything programmed already. So if they now do a little change, there are a lot of rules that you need to maintain in order not to make catastrophic mistakes, similar to the ones that Harry alluded for, like sending your USDC to the USDC contract. So even when interacting with DeFi without any malicious intent, there is still a lot of things that you can do in order to protect against those risks. So that would, again, make those likelihood of catastrophic mistakes less likely, thus probably reducing the insurance cost. And then on the protocol side, and I think that's something that from our end, we're starting to see more and more, we do see protocols embracing real-time protection tools, because audits have been there, as you said. Audits have been there since, I would not say forever, but for a long time. And everything that we have prevented and everything that we have alerted non-customers even was audited. So the audit is, and again, I'm not going against audits. Audit is a layer, so I'm kind of fair to my testament. We need all the layers. So you have done the audit layer, now it's in production. But if you don't check, if you're deploying a new market to your lending protocols and you don't do some checks in real time, then it's fine. The audit is perfect, but you'll get, basically the protocol will be wrecked. So all those things need to kind of be, I would say, embraced, because some of those tools exist. And by the way, Hypernative is I think, the biggest player in that area of protocols and how people interact with DeFi. But it's not that there are no tools now. There are tools, but we need to change the mindset that if in traditional finance and cybersecurity, Fortune 5000, whatever, no one in their right mind can say, look, I have a wallet that manages 20, 30, $50 million. And if it moves funds, I don't get an alert. It's comprehensible in TradeFi, right? It doesn't make sense, right? So we should have the same concept in DeFi. And I think what I see from crypto in the past few years, and it's something that actually a founder of, I will not mention the name, but someone that when we started Hypernative, I talked to someone and he told me, look, eventually his view was that crypto basically builds its own version of everything that you see in cybersecurity and in traditional finance. So that what he said, actually, I think kind of proves itself materializing, because we do see that we build everything, but we cannot take the primitives from the fraud solutions from a riskified in commerce world is not translatable to fraud in crypto. It's just not the same primitive. So we need to build everything. But I think those tools are being built and they're effective. We do see results in in the field. Like we uncover fraud, we uncover theft. We have good results, not just Hypernative, by the way, generally.
Yeah.
And tools like Harry is presenting, right? They're like disaggregating risk, what Harry is building. So what they have, like disaggregating between different wallets, it's out there, right? Like, is it the common practice to be, I always have to disaggregate, right? I think that's the missing piece, like having a more regulatory, proactive approach from big players to say, I always need this and that and that and that in order to disaggregate my risk and thus reduce the likelihood of an attack and maybe also reduce insurance cost.
Yeah, absolutely. And I mean, in some ways, cybersecurity is a never-ending game, right? And it's definitely a noble effort and a noble mission. And I think, as you say, right, as we develop more, eventually we'll start to then just get to the other side of that curve where it becomes more and more manageable. Okay, so look, we're almost at time here. I think it's been a brilliant discussion. We've been definitely overestimated or underestimated how long 45 minutes is, and just how much we wanted to cover in this time. I think I'm going to have to invite you all back for a forward-looking discussion on where we're going to go. But that is a topic for another time. I wanted to end, right, and we touched on it a little bit, but I wanted to get your expert opinions on the systemic risks that face the industry today, right? And I guess just to throw a little bit of a grenade into the room there, I think I was talking to one CISO and I was like, what do you think is the most terrifying thing that could happen to this entire ecosystem? He said, oh, well, that's obvious, right? It's Microsoft Azure going down, AWS going down, and being irrecoverable for a month or two. And I think by that point, right, I think half the world would be in trouble, not just crypto in itself. But that is the kind of systemic risk which I guess, Kieran, probably keeps you up at night, right, and probably affects not just your crypto book, but so many of your business lines. So we're going to finish up by asking each of you, please keep it concise, but where you think that Black Swan event could be coming from and where crypto companies should be making changes now to protect against those kinds of risks. Kieran, I'm going to go to you first.
Yeah, I think it's definitely on that systemic exposure. So think of AWS going down or Microsoft Azure or any other technology like that. That isn't unique to crypto. That, like to your point, that's across my full portfolio. So if Amazon goes down, I'm going to be in for a very bad day in the office. So I think that systemic exposure is something that's really important. I think maybe not a black swan, but I think maybe an underestimation by the digital asset industry is the role of insurance. I think it can be very strategic. I fully appreciate that insurance hasn't always been arms wide open, red carpet rolled out with this industry. I think it's taken time for us to really understand that space, and the market generally, both for insurance, but equally in the digital asset market, has matured a lot. So I think we're now past those terrible teen type stages, and we're really heading into adulthood now. And I think insurance can be a true partner in that journey. So we don't just pay claims to carry. Obviously that is our bread and butter, but we do help firms become better risks. So we look at things through governance, controls, resilience, and we really act as that almost forward-looking telescope. That is the value of insurance. We look at the what-if moment on those emerging risks that we see. So we provide that financial safety net should everything go wrong. So should AWS go down, then that insurance safety net is there. I think most importantly though, we are a partner. So we quite literally invest in your business. We put our money where our mouth is. So deploy our own capital to cover your risk. So that means that we are both personally and financially invested within your business. So at the end of the day, I think digital assets and insurance aren't on the opposite sides of the table. We are that partnership. We aren't just a safety net when things go wrong. We want to be there to help you become a better risk, become a stronger, more resilient business. But hopefully before that won't ever arise for you from a risk perspective. So I think the biggest underestimation of the black swan was maybe not a risk that might present the industry, but I think the risk would be not to think of insurance as that strategic partner. The future of this industry won't be built on avoiding risk. It'll be on taking smart risk, and I think insurance would really help you to do exactly that and transfer that risk and get it off your balance sheet and be that partner. So I'd say, I mean, obviously from an insurance perspective, I'm going to say that, but I think it is true, and it's one that's kind of been underlooked by the industry.
Yeah, brilliant. Dan, I'm going to come to you next. That future-looking view as to What could the next boogeyman be, and how do we prepare for it? What are your thoughts on that?
On a systemic risk nature?
Yeah, of course, yeah.
So I think so we had those events like I don't think it's the events such as FTX, which are kind of, they're big, but they're just very, it's a single player as big as it might be. I don't think that today those players are big enough to in the grand scheme of crypto to do, they'll do damage, but it's not in the point where you're like 95% of the liquidity in a single vendor. I think so. Something I would say we cannot foresee, but imagine something like, I don't know, like a Tether having an issue. So you have suddenly a Tether and a Circle, right? So maybe, okay, if Tether is having an issue, so okay, so funds will go to Circle. And we had that example with Circle, by the way. And I think Circle was a very nice example for disaggregating risk, because they actually disaggregated across 10 banks. And that's why exactly only 10%. So it dropped to 0.9, right? So, but this was, again, it was kind of a risk that did not manifest to its fullest, right? And everything was fine. And Circle already, like, they said everything would, and there was no actual issue. But I think if, for example, you would imagine something like a big stable coin experiencing some issue, which hasn't happened so far, it's interesting to see what would happen. Interesting. I mean, it's scary, but it's something that is I think a big risk. And of course, there is again, for something like Ethereum, whichever angle it may be, any risk to the like consensus layer, which I think that's the biggest threat, right? Like, and you don't know where it will come from. It can come from whatever, like you said, an AWS is going down. So eventually all those validators are running on some hardware, right? So I'm not sure even if AWS is going down, then the validation of Ethereum will go down. It's that disaggregated. I think we still have, as an ecosystem, some decentralization there. But a bug, or like we have bugs that are being uncovered in like 40-year-old libraries, most critical in the Linux kernel. So, and this is like very, very critical, right? So the assumption that there is no bug in this critical code that is basically like securitizing the trillion-dollar industry that we're in, I don't know if I would take that leap. So there is something that, would it be manifested? Would it be found? Would it be possible to exploit it? That's a very big difference than saying that there is some bug somewhere. So I think those are the two, like the stable coins and maybe the kind of consensus layer for a big like chain, I would say Ethereum. In our case, it's mostly Ethereum or Bitcoin, right? So I think those are the, I don't know, swans that I would be careful of.
Yeah, I had briefly forgotten about the Tether scary stories. So thanks for the timely reminder to keep us on our toes. And Harry, I'm going to come to you for our final remarks. Any perspectives on future risks, systemic risks? What keeps you up at night, and how can we all defend and prepare for those scenarios?
Yeah. Kieran and Dan took a lot of the good answers, so I'm going to have to say good job to them. I think if we try and think about like what different layers that things are built on top of, AWS, ultimately there's going to be compute. Someone's going to be running all of the validators in some way, shape, or form. So wherever that is run, that's very bad. Then next we go to consensus. If there's some issue with the chains themselves, then that's very bad. What is the next layer down is basically where do people store their funds? So if we look at where's the biggest aggregation across wallet providers, it's going to be Fireblocks. Across custodians, it's going to be Coinbase. If we think about from a normal person or individual perspective, ETFs are all custodied in Coinbase in the US, pretty much. So if there was any issue with Coinbase having a concentration risk or losing access to funds or not being able to interact with them, that would impact probably tens of thousands, if not hundreds of thousands of individuals at this point. So in terms of real world impact, all of the Coinbase customers, millions around the world, plus all the ETF holders, plus all the fund holders, and so on and so forth. So that's probably one of the areas that would have the most impact in terms of aggregation in the more normal world outside of the crypto world. And similar thing with Fireblocks, where lots of banks, lots of custodians, lots of exchanges, and more all run on top of their infrastructure. So if there's an issue with them, then a lot of other services that you wouldn't necessarily even know were running on Fireblocks. I think they have approximately 2,000 business customers, would also be impacted. And so that's a scenario which has widespread application and aggregation risk, and is probably one of the things that Kieran's most concerned about in terms of his customer base. And that's one of the things that we solve at Circuit, that we enable you that even if those large providers were to go down, who are holding your funds, you have the ability to always sweep your funds out and bring them to a backup provider and reduce that concentration risk without having to trust us. So we identified that as one of the existential risks and have built tools and technology to be able to solve it. So we'll leave it at that.
Yeah, brilliant. No, good final remarks. And yeah, I guess like to reflect on those, it's amazing, right? I was wondering what you were going to say, Harry, because as you said, Kieran and Dan, they snagged the good ones. But you did, like, I think this reflects, right? Giving you all very different but very pertinent answers. It reflects the kind of diverse risks that we face into, but also the risk collective itself, right? And how we've gathered very strong risk mitigation businesses, risk experts to be able to reflect on these things and ultimately build solutions to combat them. It gives you a lot of hope. It lets me know and lets others know that we're on the right direction, right, to actually combating some of this stuff. And despite the fact that these attacks and these emerging risks are evolving, we are indeed making good headway and kind of fighting them off. So, look, thank you very much for your time. To our users who have tuned in, feel free to reach out, right, either after this to anyone on this panel. Please do go check out Circuit, Hypernative, and Mosaic Insurance, 3 fantastic businesses. And of course, if you want to learn anything more about the Risk Collective, you can reach out to me or anyone on the Native team through our website as well, native.inc. To our panelists, thank you very much for your time. It's been a brilliant discussion. Absolutely, we'll invite you back to talk about some of the weird, wacky, wonderful things that we're going to be facing in the future. But for now, we'll call it there and see you next time.
Cool.
Thanks again, guys.
Thank you, guys.
Thanks, guys.
Take care. Bye-bye.